Introducing our new series, Market Maestros, an exclusive interview series brought to you by Arthasachi Venture, where we dwell into the minds of industrial titans, thought leaders, and experts who have left an incredible mark on the financial and IT landscape. In Market Maestros, we aim to unravel the secret of success, explore unique insight, and gain a deeper understanding of ever evolving financial and IT markets, along with changing landscape. Our conversation will not only provide a glimpse into the professional journey of our esteemed guests, but also offer an invaluable wisdom and perspective for both seasoned investor and aspiring market enthusiast. Today, I am thrilled to kick off this enlightening journey with a distinguished guest, Mr. Ram Narayanan, a true luminary in the world of commodities market, an individual whose expertise in the commodity market had shaped industry trends and inspired many. As the founder of Arthasachi Venture, we believe it is critical to bring out this conversation to empower your financial decisions and foster a deeper connect with the dynamic world of investment. So pack your bag and get ready for a captivating exploration of commodities market as we embark on the enlightening series with one of the most respected name in the industry. So join us in discovering the story behind the success, the challenges faced, and the invaluable lesson learned in the pursuit of excellence. Market Maestro is a place where wisdom meets wealth and expertise transform into insight. In our exclusive interview with Ram, we covered numerous commodities with their in-depth analysis spanning demand and supply, economic growth, supply chain intricacies, and various facets of this market. We decided to split the interview into two parts as it was driven by richness and complexity of the topic covered, ensuring that each part provide a comprehensive exploration of critical aspects without overstretching the viewers with information overload. In our riveting part of this interview with Ram, we embark on comprehensive journey through the complex world of commodities. In this segment, we not only dwell into the facets of Ram's journey in the commodities market, but also unravel how this experience have profoundly shaped his career. Our exploration extends beyond personal anecdotes. We plunge into intricate dynamics of the commodities market, dissecting volatility aspects and unveiling strategies to navigate challenges posed by market fluctuations, geopolitical events, and uncertainties. With a key eye on global stage, and global spotlight is currently on India and China as a major contributor for economic growth, dissecting the opportunities and challenges in these markets, Ram shed light on how India and China influence the steel and oil markets, being one of the largest consumers. The discussion does not stop here. We journey into the heart of aluminium and oil industries, probing the factor fueling their current volatility. We scrutinize with Ram how he foresees it evolving in the near future. As our conversation evolves, we turn our attention to understand how resilient is the supply chain in the oil industry, shedding light on measures taken to enhance stability in the aftermath of global disruptions. We concluded the final section of part 1 with Ram to bring back our focus on investor. It's a must-watch section for investor who invested in Indian public sector company within the refinery and oil marketing space. Ram shares invaluable advice for those who have witnessed a dream run in their investment and sitting on exceptional profit. You will get your answer whether you should hold on or book your profits. Introducing Ram before we embark on our interview, let's unravel the essence of our distinguished guest through this video.
Ram Narayanan boasts a rich 25-year career in the metals and chemicals industries, currently serving as the Director VP of Strategic Market and Business Development at Vedanta. With dual master's degrees from the London Business School and SP Jain Institute of Management, Mumbai, and a background in chemical engineering from LIT, Nagpur, Ram has excelled globally, managed operations in India, China, Taiwan, and Malaysia. His expertise spans metals and petrochemicals, international trading, and chief marketing roles, with a keen focus on crafting and implementing short-term and long-term business strategies and driving operational business performance. Beyond his professional achievements, Ram is an avid marathon runner, mountain trekker, and an avid blogger. Ram's journey began with Reliance Industries, where he delved into petrochemicals. A pivotal juncture in Ram's career unfolded when he embraced an opportunity to work in China, the epicenter of global commodity trade. Over the past 2 decades, this experience, coupled with extensive travel, has metamorphosed Ram into an international trade expert, providing him with comprehensive exposure to commodities trading, financing, and shipping. Today, Ram stands as one of the most sought-after professionals, effortlessly harmonizing profound industry expertise with a global perspective.
Hello Ram, welcome to Market Maestros. Let's kick off our discussion by knowing a bit about your journey, especially your experience at London Business School and how they shaped your career in the commodities market.
My first foray into commodities market was after my first MBA when I joined Reliance Industries Limited at its corporate headquarters in Mumbai. I was posted to the polymers business in the international business division. At the time, Reliance was expanding its facilities, so it was imperative that they had to expand international markets. So that was a great exposure for me, working with all aspects of international business, right from sales, logistics, financing, documentation, and customer handling. So this was my first foray into commodities, and this was in the field of polymers, polypropylene and polyethylene. And since polypropylene and polyethylene business are heavily influenced by the crude oil markets, it was imperative that I learn the dynamics of the crude oil market also and the complete value chain. So thus I built up my base in commodities. During my stint in that job, I got the exposure to work in the Southeast Asian market, Northeast Asian market, and especially China. And China being the biggest market, as well as biggest influence of global commodities market, understanding the dynamics of China was a great learning for me. My biggest break came in the next job when I worked with Sterling Technologies, where I was given the opportunity to develop the business base for optic fiber and cables in China. I lived and worked in China and built up an office there with the local people. So this was a great exposure for me. During this time, I learned about the Chinese way of doing business, the Chinese systems, the legal system, the finance system, the banking systems, the political systems, as well as the culture. I traveled extensively across China and I learned about how China works and how Chinese market influences the global markets. During this time, I also got the opportunity to work in Taiwan also, because I was handling the Taiwan market based out of China. So this was the biggest exposure for me, and this catapulted me to my next job, where I was given the opportunity to build the international business division of the aluminum business of Vedanta Limited. Here, I had to build up a complete base for aluminum business, right from markets, logistics, supply chain, financing, documentation, banking, etc. Apart from the Asian markets, I also got the opportunity to work across the globe, especially in Middle East markets, Mediterranean markets, Europe, Africa, and other markets. This gave me a wide exposure across the globe, and also gave me the managerial exposure to build up an international marketing team. During this time, I also had the opportunity to handle the supply chain for the business, because the raw material was being imported from various countries across the world. So with the main exposure being from Australia and South America. So hence, during this stint, I got a wide exposure to handling various markets and building up an international business base. I went to do my second MBA at London Business School after about 12-13 years of WorkX. I chose London because London is the hub of global commodities trade, especially the banking system of London handles a good part of global commodity trade. And the field of metals, London Metal Exchange, which is the hub of metals trading across the world, is based in London. So during this time, I got the opportunity to meet and network a lot of people in London Business School, from people from various parts of the world. And also, since London being the hub of commodities trade, I got the opportunity to network and meet with various people in the commodities trade, including the banking channels, the financing channels, the logistics channels, and the trading partners. So this stint at London gave me a wide exposure to my work exposure, which I had earlier in the field of commodities. That's how I built up a platform for me in the field of commodities trade and international marketing, which I leveraged later upon in my career.
Ram, thank you for sharing insight into your dynamic journey in the commodities market, spanning from Reliance industry to multiple international roles and specifically China, and then your current stint at Vedanta. Now let's understand into how you navigate through the intricacies of the commodities market. Commodities market are often volatile. How do you navigate the challenges posed by market fluctuation, geopolitical event, and other uncertainties?
Well, commodities market by nature and by structure are often volatile. The reason being, they reflect the geopolitical events, the various trade embargoes, supply chain shocks, demand shocks, and various other aspects of the global markets. So therefore, a person who is playing in the field of commodities has to have the DNA and the inbuilt ability to handle these kind of volatility. Now, across my experiences in various commodities and in various markets across the world, the few things which I have used to handle these kind of volatilities is have a business model which is flexible enough. Some amount of flexibility is needed to build into the business model, more from a market perspective as well as from a supply perspective. And second thing is have a robust risk management system which can help you tide out these kind of crises. So let me take it one by one. When I say having flexibilities in a business model, the way I used to construct the contract was to have a bit of flexibility. For example, in my sales contracts, I used to have a mixture of end user contracts and some trading channel contracts. Have a bit of flexibility in the logistics. For example, sometimes between break bulk and containers, sometimes in CIF and FOB. And also, secondly, have a mixture of long-term contracts and some amount of spot contracts. Now, long-term contracts gives you a lot of value, especially the end users, but there are many times when many of the end users might have some issues for production issues or something. At the time, you will need to have the flexibility to play the spot market. And when you have to play in the spot market, it also gives an opportunity to participate in the pricing mechanism of the particular commodity. So this is the way I used to build up the flexibilities in the contract. And the second aspect of this contracting is something which is become very important right now. You used to have a hedging mechanism. Now, when I mean hedging mechanism, like quite a bit of flexibility is built up in the physical contracts, but every every player, like especially for a manufacturer, you need to have some stability in your cash flows and stability in your profitability. So therefore, whatever is the flexibilities that is given in the physical contracts can be covered up with a risk management facility on the hedging side, which is the paper trade. Now, especially in the field of metals, you have got a lot of exchanges which offer a lot of options, like London Metal Exchange, Shanghai Futures Exchange, Singapore Exchange SGX, and including in India we have the MCX. So therefore, whatever the risk that a player is exposed to in the physical part of the contract can be covered up by the paper trade on the futures exchange. So hedging mechanism is something which is very, very important, not only to cover up your risk but also to smoothen out your cash flows. In fact, there are many global players like Norsk Hydro which on a consistent basis hedge about 20 to 25% of their sales on a forward basis about 2 to 3 years ahead, so that they have visibility of their cash flows. So this is the way I think volatility can be managed. And the third point is to having a robust risk management mechanism, which includes market intelligence, which also includes what are the threats that your business faces, so that you can take some actions to take care of the volatilities that can happen in the business. Let me give an example. For example, about 2 years back, the Russia-Ukraine war started, many of the commodities prices went up through the roof. So the players in especially fields like aluminium and probably nickel and all, they saw the prices go through the roof and were laughing all the way to the bank. But after 3 to 4 months, the prices started coming down, mainly because of the demand started petering out. So therefore, you should have a robust risk management mechanism which not only includes a market intelligence but also the actions that a company needs to take so as to safeguard its interests. So to summarize, to handle these kind of volatilities, a player should have flexibilities in the business model. That's number one. And risk management is very, very important, which includes hedging mechanisms as well as have a robust risk management system to take care of these kind of volatilities.
The global spotlight is currently on India and China as the key player for economic growth. India has successfully maintained its leadership position, while China is actively striving to overcome the challenges posed by economic slowdown. Ram, could you provide insight into the specific challenges and the opportunities in the key market like China and India that significantly influence the steel and oil market, being one of the largest consumers?
Well, India and China are one of the major players in the global oil and steel markets. Let me just give you a few numbers. Oil, as I said earlier, out of global consumption of about 102 million barrels per day, China accounts for 16 to 17 million barrels per day of consumption, while India accounts for 5.5 million barrels per day of consumption. Adding both this together, that means about 20% of the global oil consumption is accounted for by China and India, and both are heavily importers. China needs about 80% of its oil requirement through imports, while India requires close to 85 to 90% of its oil demand through imports. So therefore, both of them are the markets which sway the global oil markets, and both of them have shown the inclination to take Russian oil also, despite all the bans. So therefore, from oil markets perspective, imports into India and China are huge opportunities which many people already encashed upon. One of the things that can, just to give a bit of statistics is, Chinese oil demand in tune with their economic growth might slow down a bit. In 2024, as per IEA estimates, Chinese oil demand is expected to grow by about 2.3%, while Indian demand is expected to grow by 4%. So therefore, the criticality of India in the oil market will keep on increasing. So there are a number of opportunities there. Another major factor which many people probably might not know was both India and China are big exporters of oil and refined products. India export huge amounts of gasoline and diesel, aviation turbine fuel, and so does China. So India has been a major supplier to Europe after the Russia-Ukraine war. So therefore, they have kept a balance in the market. And similarly, if you look at China, China is also a major exporter of these refined products in the Asian markets. So therefore, good opportunities lies out there for people who want to play in these markets, given the fact that India and China are major exporters also. In fact, China has done one very interesting thing. Their annual oil import quota, which they release in different phases across a year, they have released a complete quota in January itself, and with an inclination that they might release some more quotas for some of the oil to chemical companies. So therefore, that is a criticality of oil business to the global markets from Indian Chinese perspective. Now next to steel markets. Now, as everybody knows, China is the world's largest producer of steel. Let's say close to 1 billion tons of steel, while India is the second largest producer of steel. Let's say 130 to 135 million tons per annum of steel. Now, China has put some cap on steel market, steel production expansion because of various environmental concerns. While the Indian government has actually got a policy to increase the steel production close to 300 million tons from the present 130 million tons by the year 2030. So therefore, the criticality of India in the global steel market will increase, and one of the major factors is China imports iron ore, which is predominantly from India, and also imports some part of its coking coal, while India imports almost all of its coking coal requirements from predominantly from Australia, some from Russia, and some from other nations. But in the days to come, with the Indian steel production increasing, Indian iron ore exports might decrease, while the criticality of the Indian market for the coking coal imports will increase. So in fact, there's a big case going on to show a coking coal price marker for India as one of the major developments in the days to come. So therefore, so given the fact that the dynamics of the oil markets and steel markets are changing a bit, and both India and China will have major role to play in this market, but India's role in these markets are increasing given the way the Indian economy is increasing, given the way the demand for oil and steel will increase in India, and steel especially because the production base is increasing in India. So, and also thirdly, as I said before, the focus on sustainability, especially green steel production, is also being focused upon in a big way with both India and China. So that will be another major opportunity for people to play in this particular market. So net in all, I think a lot of opportunities for people in the oil and steel market, especially when it comes to India and China.
Now, let's extend our discussion to aluminum and oil industry. Aluminum and oil prices have experienced noticeable volatility. What factors are contributing to this volatility, and how do you foresee it evolving in the near future?
Okay, oil market is oil as a commodity is the widest and the highest traded commodity across the world, and is a perfect reflection of the geopolitical and economy across the world. Now, oil over the last, let's say, 6 months, oil prices has moved between $70 to $95 per barrel, which shows a kind of volatility which oil prices have gone through, which is a perfect reflection of the volatility that we've seen in the geopolitical events across the world. Now, from a supply perspective, which is most important in oil, the major factor that has played are the OPEC, as the OPEC cartel. The OPEC controls about 30% of the global oil trade. And so in July, they announced a production cut of 2.2 million barrels per day, and to stabilize the prices. And also they have been talking about introducing further cuts, given the fact that in 2024, the global oil demand growth is expected to be slow, mainly because of our slowdown in the Chinese economy. But however, because of the various politics between the OPEC players, we still haven't seen the cut. But essentially, the way OPEC plays the game is what is one of the key factors in the market. Another major factor in the last 2 years has been Russian oil supplies. Now, Russian oil supplies after the war started has been predominantly going to China and to India. In fact, in India, which was hardly importing 1 to 2% of its needs as before the war, now imports close to 35% to 40% of its needs from Russia. So, and Russia also recently has cut its production also by about close to half a million barrels per day. So therefore, that's another factor that has been playing into the market. A third factor which has been playing in the market has been the increased supplies from US. Now, USA, we've seen something very, very interesting. With the same number of oil rigs, they have increased their supplies. And USA supplies has increased over the last 6 to 7 months. And that has flooded the global oil market. So that's another factor which has played in the market. And there have been some, outlier events like Venezuela, which had a political embargo, has been allowed to ship its oil. That is number one. We've seen some outages in Libya because of these skirmishes there. So therefore, the supply scene of oil, which is highly volatile, has been playing in the oil market. So which has been one of the major drivers for volatility. Now coming to the demand side, one of the major demand factors has been the demand from China. Now China, because of its slowdown in its economic growth, will see some amount of slow offtake in oil. So slow offtake in its oil growth. Despite the fact that China has already announced its full quota of oil imports at the starting of the year, as compared to various phases we used to do earlier, and China's demand is still a bit of a question mark. So that is one of the weaknesses which one can see in the market, because of which prices have seen some bearishness over the last 3 to 4 months, given the fact the way Chinese market has behaved. Of course, Indian demand growth has been very, very strong, but Chinese demand growth at 16 million barrels per day as compared to Indian demand at around 5 million barrels per day actually swings the needle a little bit more as compared to what in the Indian market can. And of course, there are other green shoots of strong demand, probably we can see from Vietnam and all. So therefore, given the various forces at play in the global oil supply from a supply and demand perspective, so therefore oil prices have been very, very volatile. And given the way the global market is going to be from a demand perspective, growth perspective, and geopolitical perspective, this volatility is bound to be there. I think we need to live with this. So that's my view about the oil markets. Now coming to aluminium markets has been also been similarly affected with similar kind of dynamics, slightly different though. One of the major factors for aluminium has been the slow demand offtake from China. And then also aluminium, also given the fact that it is predominantly used in various sectors which is aligned to the global demand, global GDP growth, is seeing some signs of bearishness. So therefore the prices are hovering between 2100 to 2200 and might go down a little bit further also. So that is from a demand perspective. Now from a supply perspective, we saw some amount of spike in aluminum prices in December, mainly because there were some issues in bauxite supplies from Guinea, the world's largest bauxite supplier. Because of the prices shot up, but subsequently it came down again, which reflects that basically the demand for aluminium is still pretty soft across the world, and the outlook is going to be so. China has imported huge amount of aluminium. I think if I get my numbers right, China has increased its imports in 2023 by almost 40-45%. 40-45%, but it's exporting quite a lot of the downstream products. And also secondly, what has also happened aluminum business is the prices of raw material also come down. So today at a price of 2100, 2200, almost 97-98% of the smelters are EBITDA positive, making margins in the range of $300 to $400. So this price are pretty comfortable for all the smelters to make money, and given the slightly bearish demand outlook, so therefore any expectations of a major upside, unless until there is a supply chain shock, looks to be a little bit weak. So therefore, again, aluminum prices varied between $2,000 to $2,300 the last 6 months. Again, it's a reflection of the volatility in the market, very similar to oil. So this year also I foresee that such kind of volatility is going to be there in the global oil and aluminum markets.
Given the recent global disruption, including the shifting economic dynamics between the US and China and ongoing conflict in Europe and Middle East, the commodities supply chain has been significantly affected, specifically in the oil industry. How resilient is the supply chain, and what measures are being implemented to reinforce and enhance its stability?
Well, the recent sort of volatility in the global oil markets, as I said earlier, have been mainly due to supply chain disruption because of what OPEC does. OPEC controls about 30% global oil supply, and also because of geopolitical events like the recent Red Sea crisis. That is number two, and also because of some weakness in demand, especially coming from China. So that is number three. So therefore, So therefore, there is so all this kind of volatility in the oil markets reflect in prices, which I said earlier has varied between $70 to $95, which I've seen in the past. Now there have also been many other supply chain issues, like 2 years back, Iranian oil supply started coming back to the market. Recently, we've seen Venezuelan oil coming back to the market. And then we've seen some outages in Libya. Angola has quit the OPEC. So therefore, all this is reflected in this oil market supply shocks. Now, of course, the world has to live with this kind of shocks. But if you look at it from a hawk's eye view, where are the what things can be done so that some kind of shocks can be taken care of by the market? What are the resilience built up into the system? Okay, let's look at from a spare production capacity. If you look at today's production of 102 to 103 million barrels of oil per day, at present it is estimated that the spare capacity is something close to 4.5 to 5 million barrels per day, which is predominantly with Saudi Arabia, as well as with some with UAE, and probably like I expect there is some with Russia also, given the fact that they recently cut some amount of oil production. So therefore, in case of any other major outages and geopolitically everything comes together, I think there's a bit of spare capacity available to take care of the supply shock. That is number one. Another interesting thing has happened with the increase in US supplies. Now, US supply has increased to about something like 13.2 million barrels per day over the last 6 months, as compared to 12.3 million barrels per day of supply at the same time last year. Interestingly, US increase in supply has come from a reduced number of rigs. At present, it's estimated the US has got 499 rigs operational, as compared to 621 rigs that was operational last year. So we have seen something like, let's say, a 16 to 17% drop in the number of rigs, but the oil production has gone up by something like 10%. So therefore, the increased productivity from the US oil rigs has led to more supply. So there's another resilience that has been that is there in the system. Now, third point is whenever there are oil price dips, many of the countries have filled up their special petroleum reserve stocks, including all the major countries like USA, China, and India. It's estimated USA has got SPR reserve of something close to 18 days of consumption. China, in fact, has got much more bigger. It's estimated they have something like 30 days of production, 30 days of consumption, while India too has got SPR which can take care of 5 to 6 days of consumption. Now, it has been seen in the past, including in USA, whenever there is an oil price hike, the countries resort to releasing of these reserves so as to cool off the prices. So that's another way by which some of the resilience has been built up into the system. Now, another bigger thing that has happened globally is how the different countries have adapted to take the different kinds of crude. The biggest examples are China and India. After the war started in Ukraine and Russia, India and China have taken up Russian crude in a big way. If I can talk about India, India, which was importing hardly 2% of its requirement from Russia before 2022, now imports close to 35 to 38% of its requirement from Russia. In fact, went as high as 45% about a few months back. Most of the Indian refineries, including private and public sector refineries, have had the flexibility to handle the different kinds of Russian crude also. The Urals Russian crude, they've been able to handle it. And this has brought stability into the market because Russia was a major supplier to Europe. Now, after the war started, when the Europeans stopped taking Russian supplies, Russian oil has been shipped to India, while India's refined oil products like diesel and gasoline has been shipped to Europe. So this has helped to maintain stability in the market, in the downstream products also. So therefore, net in all, spare capacities, the flexibility in the business models, as well as thirdly, some increased supplies from other sources and increased productivity as what is seen in the US oil rigs has indicated there is enough resilience into the system. So therefore, even though volatility is high, the prices have remained range bound between 70 to let's say around 90, and the world has got used to living with these kind of prices. So that's the way the resilience has been built up into the system as I see it.
With your in-depth coverage on oil, I'm profoundly impressed by the lucidity of your thoughts Your insight not only demonstrate a profound understanding of the commodities market, but also underscore the temporal and substantial dimension you invest in your analysis. In extending this discussion to cater to our investors, particularly those based in India and globally, it would be enlightening to receive your perspective on the remarkable surge observed in the Indian market pertaining to the public sector companies in the refinery space and oil marketing domain. What advice do you offer to the investor who has seen a dream run in their investment and sitting on an exceptional profit?
Well, here's my thought on the Indian PSU oil refining companies. The Indian PSU oil refining companies have had a dream run over the past maybe few years because of the following reasons. One is the availability of cheap Russian crude. And if you look at the discount that is being offered over the benchmark Brent, most of the Russian crude, which is predominantly the Urals, have come at a discount of somewhere close to $15 to $18 per barrel. That is something, $15 to a barrel, that is something like, let's say, 20-25% discount. So net is like, the cost of raw material has gone down for them. The second point is from a pricing perspective. Well, in the domestic market, especially price of petrol and diesel have been held fairly constant, and so one of the ways that the government has been tweaking around the prices, especially in different times, is tweaking around with the taxes like VAT. So net is the government has been playing on its taxes. So therefore, the basic realization to all the oil refiners has remained fairly constant. Third thing is the demand for the refined products like gasoline, diesel, aviation turbine fuel, and other products has been very robust. If you look at the gross refining margins, which is an indication of the earning of the companies over the base crude price, it has been very robust. If you look at the recent results of some of these refining companies, it's been, even though it's seen a drop over the last maybe 1 or 2 quarters, but if you look at the historical average, they've been pretty strong. So therefore, that's one of the ways by which the revenues of all these companies have remained very strong. And also from a valuations perspective, the government of India has been talking about the disinvestment of these companies, especially BPCL, and hopefully after the elections again this will gain traction. And another major point when we come to these oil companies is the proportion of the products which is chemicals. Like globally, we've seen many of these big oil refining companies, especially in China like Hengli and Hengi, having oil to chemicals ratio of about 45 to 50%, while most of the Indian companies are around, let's say, between 10 to 15% and probably around 20%. Now, many of the local companies like BPCL are undertaking capital expenditure plans, have honest capital expenditure plans to increase the chemicals ratio. So therefore, from a future valuations perspective, this outlook is pretty positive for them. So net, I'm pretty bullish about all these companies. The market gives them a valuation for their business model A, and B is for a steady source of revenues which the government has ensured. And so therefore, I see a pretty good future for all these companies, and especially the government is able to take care of the disinvestment program and disinvest a part of its holding in these companies. And let's say we have some private sector participation coming in. So the future is, I can see, is very robust for all these companies.
In our part 2 of our exclusive interview with Ram, where we dive deep into the dynamic landscape of commodities, in this portion we turn our attention to the commodities exchange in India, still in the early stages compared to more developed markets like US, UK and Singapore. Ram shares his insight on how he foresees their evolution over the next decade, promising a glimpse into the future of burgeoning markets. In the face of global warming and escalating environmental challenges, sustainability has taken center stage we explore how the steel industry, a major player in the commodities arena, is adapting to these pressing environmental concerns. This segment promises an insightful look into the industry's commitment to sustainability and strategies employed to navigate this pivotal shift. As we shift gears, our focus sharpens on the future outlook and predictions, covering key commodities like oil, steel, copper, and aluminium. Ram unraveled the trends, factors shaping the trajectory of these markets, providing invaluable insight for investors and enthusiasts alike. So whether you are a seasoned player or a newcomer, this section holds critical information for navigating the complexity of the commodities landscape. For the aspiring young professionals eager to carve a successful path in this field, the last section is a must-watch. Drawing from his rich experience as a seasoned leader and a veteran in the commodities market, Ram shares guidance and valuable nuggets of wisdom. So join us as we conclude this enlightening session with Ram, offering a roadmap for success in the ever-evolving world of commodities. Thank you for joining us for an enlightening journey through the intricate landscape of commodities where wisdom meets opportunity.